Is the S&P 500 still a long-term buy and hold, or do I sell after the run-up? If you've been invested in the S&P 500 in the last year, the year-to-date return is about 17%. If you've been invested in 2024, the return in the S&P 500 for the year was 23%, and in 2023, the return for the year was 24%. In fact, one could argue that after the financial crisis of 2008, the S&P 500 has done nothing but go up in value. This has led many value investors screaming that the S&P 500 is overvalued and it is due to see a correction. As a result, it begs the question if the overperformance can continue, or shall we sell and look for quality businesses with more attractive valuations. In this video, I will decide if I should continue buying and holding the S&P 500 long term or sell it due to its high valuation. Like with all things, there are two sides to every story, so I consulted my good friends Mr. Bull and Mr. Bear to share their ideas of what I should do. Mr. Bull, would you like to go first? For sure. Over the long term, the buy and hold strategy of the S&P 500 has worked. Even the most successful investor, Warren Buffett, has said that for the everyday investor, buying and holding the S&P 500 is an ideal choice for equity exposure. In fact, Buffett put his money where his mouth is in the Berkshire Hathaway's 2013 letter to shareholders when he stated that the advice to the trustees of his wife's portfolio would consist mainly of a low-cost S&P 500 index fund. Buffett argued that a very low-cost index fund is going to beat a majority of amateur-managed money because it is very difficult for individuals to identify undervalued businesses and have the temperament to buy when prices have been suppressed. Mr. Bear, are you sure you can identify undervalued businesses and have the temperament to buy when the prices of those businesses have gone down? Buffett also believed that holding the S&P 500 would beat most professional money managers due to high cost. Historically, the S&P 500 has returned about 8 to 10%, and if the cost is high, it eats into the return. But buying and holding the S&P 500 has extremely low fees. For example, if you're buying the ticker VOO, which is the S&P 500 index fund, the expense ratio is 0.03, meaning for every $1,000, the cost of holding the fund is 30 cents. However, if you were to hire a professional money manager, the absolute minimum you would be paying is 1% for them to manage your money and 20% of the returns as performance fees. Even if they do outperform the market, which evidence has shown that most of them don't, in most cases the cost to manage your money will reduce your return to below the 8 to 10% mark that the S&P 500 brings in. Mr. Bear, can you find a professional money manager that consistently brings in an 8 to 10% return after their fees? Looking back at history, it is evident that buying and holding the S&P 500 has worked. Think about the amount of turmoils, fears, wars, and recessions we've had in the past 20, 30, 40, or even 50 years. The S&P 500 has kept chugging along and has produced new all-time highs. History has shown again and again that even if there is a significant drop, the S&P 500 comes back stronger every single time without fail. It is more important that you stay invested in the S&P 500 as timing the market loses more money than any drop there is. As the famous investor Peter Lynch says, far more money has been lost by investors preparing for a correction or trying to anticipate a correction than has been lost in the correction themselves. That is why Mr. Bear's point of wanting to sell is so silly. Selling the best companies in the world just because you think it might drop in the near term makes no sense. As long as you stay invested through thick or thin, you will come out on top in the long term. In fact, as Nick Maggiulli, Chief Operating Officer at Ritholtz Wealth Management, author of Just Keep Buying, and the writer of the blog of Dollars and Data, argues that there are 3 words, just keep buying, that can make you rich. Maggiulli's point is that investors focus too much on the right time to buy stocks because they don't want to buy at the peak and watch the value of their holdings go down dramatically. However, data has shown over and over that even though a market is expensive, it can still keep going higher and higher. As British economist John Maynard Keynes once said, the market can remain irrational longer than you can remain solvent, meaning you can lose a lot of possible gains waiting for the market to correct. One thing that remains true no matter who you are is that you can never time a correction. That is why Maggiulli suggests you should just keep buying, just like you would buy food no matter the economic environment. To nail in this point, Maggiulli shares a story of a man with the worst investing luck in the history of mankind. The man made 4 large purchases between 1973 and 2007. He bought in 1973 before a 48% drop in stock prices, bought in 1987 before a 34% decline, bought in 2000 before the dot-com bubble burst, and bought in 2007 before the Great Recession. Despite these 4 large purchases that totaled a little less than $200,000, he ended up with a $980,000 profit for an annualized return of 9% as of April 2017. The real secret to his investing success was that he never sold. Selling is selling out of your future wealth. Instead, we should keep accumulating by buying no matter what. Alright, Mr. Bear, Mr. Bull has made some great points, but please tell me what you have to say. Valuations matter. It always does. Even though the S&P 500 index is composed of the best companies in the world, we cannot pay an infinite price to acquire them. If we do, we could face years or even decades of underperformance. What Mr. Bull failed to show you in the S&P 500 chart is there has been long periods of underperformance because the markets ran so hot previously. In fact, if you bought at the height of the dot-com bubble in 2000, it took nearly 7 years for the market to recover and get back to where it was. Then the Great Recession hit, dropping the market once again. This was not the first time an underperformance of this magnitude occurred with the S&P 500. Between 1929 to 1938, the market dropped 68%, followed by a boom. Then a 63% drop between 1968 to 1982, followed by another boom, and then a 60% drop between 2000 to 2009. Now Mr. Bull is going to say the market recovered every time and went to new all-time highs. But think about the opportunity cost that was missed. What if we didn't have to endure a multi-year drawdown? Now, I'm not predicting a crash because those are impossible to predict. And I'm not telling you to stop investing because like Nick Majuli said, selling is selling out of your future wealth. But how about we move our money to something where valuations are not sky high? Look at Warren Buffett and Berkshire Hathaway. Although he is a big fan of the S&P 500 index fund, he is piling cash, about $382 billion to be exact. If the S&P 500 was such a great buy at these prices, don't you think you'll be buying the index? In fact, if there were deals to be made at a reasonable price, don't you think the best investor in the world is going to make those deals? Instead, he has his money parked in 3-month treasuries waiting for an opportunity to deploy cash. Again, we don't know what will happen with the stock market. It can keep going higher and higher. It is completely possible, but I just want to miss those 60% drops in the market. I am fine missing some gains or underperforming the market for a little while to miss those catastrophic drops because although no one can predict when a crash will occur, we all know with certainty that one will eventually happen. We also have to think about the risk and reward, which is the essence of investing. Right now, how I see it is the S&P 500 is only offering a dividend of 1%. The Magnificent Seven are all doing major capital expenditures, lowering cash flows, and every valuation metric is sky high. From PE, Shiller to the Buffett indicator, which means the risks are piling up. However, as a result of the high prices of the S&P 500, the reward is now lower. Looking at JP Morgan's Guide to the Markets, we can see that higher valuations leads to lower future expected returns. As of right now, we are looking at 2% to negative 2% return on the S&P 500. In my opinion, the reward does not justify the risk the market presents right now. What do you think, Mr. Bull? Is 2% to negative 2% a good return to you? The last thing I'm going to end with is rehashing a bit of history. Now, this isn't a complete apples to apples comparison, but I think the message will resonate. Look at the Nikkei index from 1986 to 1989. The index ran 43.8% in 1986, 14.6% in 1987, 39.8% in 1988, and 29% in 1989. In fact, between 1982 to 1989, the annualized return of the Nikkei 225 index was 39%. On December 29, 1989, the last trading day of the decade, it hit an all-time high. At the time, the price-to-earnings ratio was around 60 to 70, and the dividend yield for the index was 0.33%. Now, the rest of the chart explains it all. It wasn't until February 22, 2024, before the Nikkei eclipsed its previous all-time high 35 years ago. Think about the opportunity cost if you stayed invested in the Nikkei. Yes, it recovered and went on to new all-time highs, but it was 35 years of nothing. Not to mention, it was 35 years of inflation eating away at the value of the yen. At the other end of the stick, if you did sell and move on to another opportunity, you had to sell at a capital loss. As Warren Buffett said, rule number 1 in investing is never to lose money, and rule number 2 is to never forget about rule number 1. Now, I'm not saying the US indexes are going to have 35 years of nothing. nor am I even predicting a crash of any kind. All I'm saying is valuations matter, and when there's overconfidence, speculation, and monetary easing in the markets, it will create an environment where asset prices balloon. Eventually, and again, I don't know when, but the detachment between valuation and fundamentals will close, and once it does close, it will be stock prices dropping or years of stock prices remaining flat until the valuation matches the fundamentals. As Mark Twain famously said, history doesn't repeat itself, but it does rhyme. And call me crazy, but I don't want to be there when history does rhyme, even if it does cost me some returns in the near term. There is no argument. The S&P 500 holds the best companies in the world, and I am sure if the market does drop, it will certainly recover onto new all-time highs. What I am saying is the price you pay matters. You cannot pay an infinite price to accumulate even when they are high-quality assets. I'm not telling you to sell everything you have and wait on the sidelines until the market crashes because that is silly. All I'm saying is that as long-term investors, we should look at the risk and reward of our investments and not blindly throw money into something we think will go up forever. At this current time, the risk of the S&P 500 index outweigh the rewards, so why not look elsewhere? This could be individual stocks or other indexes around the world. In fact, many international markets outpaced the S&P 500 last year. Maybe there's something in the international markets that offer a better risk and reward? Unlike Mr. Bull, I am not so worried about making the quote-unquote average or market returns of 8 to 10%. The only thing that matters to me is my long-term financial goals. Please explain to me what shame is there to underperform the market but achieve my financial goals. There is absolutely none. I am currently bearish on the S&P 500 because I'm not sure it will get me to my financial goals due to its high valuation leading to lower future returns and the possibility of the market selling off to years of stagnation before reaching new all-time highs. Therefore, I'm looking elsewhere hoping to find better risk and reward investments. Thank you both for your ideas. I think I know what to do now. Both sides have valid points and only time will tell how this plays out. Was any points missed? If so, please leave a comment below. Thank you for tuning in and see you guys in the next video.